The most significant wealth transfer in history will happen over the next 2 decades. In this video, we'll talk about the strategy 99 out of 100 richest American families use to pass on their assets and minimize the estate tax, so you can take advantage of it as well. I'm Monty, the founder and CEO of Valur. The estate tax can be a significant barrier to passing wealth on between generations. The estate tax forces individuals who gift more than their lifetime gift exemption, currently $13 million, to pay at least 40% in taxes on the value they gift above $13 million. Fortunately, well-defined strategies can help people with large estates minimize their estate tax and maximize their family's returns. In this video, we'll talk about Grantor-Retained Annuity Trusts, or GRATs, their benefits, how they work, and how people use this to avoid the estate tax. So let's get started. What is a GRAT? A GRAT is a powerful estate planning structure that allows individuals and families to eliminate estate taxes as they pass on assets to the next generation. So how do GRATs work? The trust creator, or the grantor, puts assets in a GRAT for a fixed period of time. Then a portion of those assets are returned to the grantor every year. And by the end of the trust term, the original principal plus interest has come back to the grantor. You may be wondering, if the grantor gets back the original principal plus interest, what's the point? The GRAT's magic comes from the difference between what the grantor should get back and the asset's growth, or what they become worth during the trust term. The IRS requires that the trust pays the grantor an allowance. That is essentially the government's interest rate on their principal. If the trust assets grow faster than that interest rate, money will be left in the trust at the end of the term. That amount may go to the grantor's beneficiaries, such as their kids or a trust, without the grantor using any of their lifetime gift exemption or facing the estate tax. So you're wondering, this sounds great. How can you set this up? You as an individual would set up the trust, select the assets you want to contribute. Then you designate who is a beneficiary other than yourself. Could be multiple people or a trust. Once the GRAT starts, you'll receive an annual payout from the GRAT over the length of the trust. That payout is equal to your principal plus the government's interest rate. The assets in the trust, you'll be allowed to reinvest. And when the trust ends, after it's given you its required payouts, whatever remains is distributed to your named beneficiaries, free of the estate tax and without using your lifetime gift exemption. Let's say your trust assets don't outpace that government's growth rate. That would mean you leave nothing to your heirs, but it would leave you in the same position if you hadn't set up the trust, as all that money's back in your estate. Hence why it's joked the GRAT creates a heads you win, tails you lose situation. Now let's walk through an example. Let's say Sam is a successful entrepreneur and she has $25 million in assets. Her investments are primarily her company stock, about $20 million, plus $5 million of liquid income and a home. Sam wants to maximize how much wealth she can transfer to her children. So Sam has decided to set up a GRAT. She wants to set up a 10-year GRAT. She could choose any number of years. 2 to 3 is typically common, but she's gone with 10. Sam contributes $15 million of a company stock based on today's value. Because Sam has set up a 10-year trust, each year she'll receive $1.75 million from the trust, essentially her 10% of the original amount plus 3% based on the government's interest rate at the time. The government expects her company's equity in the trust to be worth roughly $17.5 million in 10 years. But due to how well Sam's company does, it turns out to be worth about $217 million. That means the extra $200 million in the trust passes on to Sam's kids and family without using her lifetime gift exemption or facing the estate tax, saving them about $80 million. All right, that wraps up the video. I hope you enjoyed it and learned a lot. Please let us know if you have any questions. Please like, share, and subscribe to learn more about all types of tax-saving opportunities. Now, a quick word about Valur. We've built a platform to give everyone access to the tax planning tools of billionaires like Facebook founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up, and administer these structures at a fraction of the cost of competitors. I really hope you found this video useful. If you still have any questions, please visit our website at Valur, VALUR.io, where you can read more content on these subjects, play with our online calculator to discover your potential financial gains, or schedule a call with us.